All right, markets definitely remained choppy after 5 days of consecutive rally. And of course, it's been the IT stocks which have led the market meltdown in today's trading session. But apart from that, we also had a big news that came in from Reliance Industries where the board has approved the IPO plans for Geo platforms. But yes, so let's talk more about markets and of course how it looks like for the long term. We'll move on to our next guest of the show. We have market expert Sunil Subramaniam joining us to talk more about markets from here on as well. Sunil sir, good afternoon. So good to have you back. Let me start off with the first question. Your first take on the markets. Some breather today, but overall the Nifty has logged in second day of second weekly gains. Can we say the worst of the war-led sell-off is finally over now?
Worst of the war-led sell-off, you can say in a way it's over. Yes, I agree. But the war-led sell-off itself, if you look at it from a broader market perspective, right, the markets recovered quite before. It's only the large cap where the pressure has been felt of the war. I was just looking at the 3-month return. I know the war was a little longer than 3 months. So today we're then talking about, let's say, March 20th to now, right? If you're talking today. So what happens is that the market fell and rapidly recovered. And I was so stunned to see the microcap index 3 months, it's up 27%. The small cap index is up 18%, the mid cap 14%. So clearly, well into March itself, the broader market recovered. It was the larger cap space which was under pressure and some amount of the larger mid caps. And the reason for that is that right through this wars period, domestic investors have retained their confidence on the markets. So if you see, whenever FII sold a lot, a DII stepped in. And even apart from that, if you've been tracking the breadth, advance to decline ratio, they've always been generally been in favor or strongly of advances, which means, and like you said, as I said, micro caps have done well. So individual level stock buying and those which have corrected have actually been bought into by domestic. So to me, the I wouldn't call it retail, but a non-institutional players domestically. So you can take retail, HNI, prop books, family offices, portfolio management services. They've all been consistently buying. So and that resilience has been quite strong. Now, yes, large caps because FIS obviously have been selling continuously. And there you can say that the war impact is now beginning to be seen. Right from the middle of, let's say, 10th of June, you've seen FIS selling come down. It's still not turned strong buyers. For them, I think there is still a lot more clarity needed, but at least the intensity of selling has come down. So in that sense, I think the worst is clearly behind us in terms of the war-related impact. So your assumption is right. But for the market, especially larger cap, to touch newer highs, you will still need FIS to come back. And I don't sense that happening too soon. It's not related to the IT sell-off today, but I've been finding that FIS, if they're buyers, they're 100, 200 crores buyers. The selling has come down to maybe 1,000, 2,000 crores. But when they buy, they are not buying in big chunks. So there's still probably the, oil at $80. They're still not fully comfortable, FIIs. Second is you have the monsoon also, which is a key driver of rural consumption and food inflation, which is again probably a thought. Third thing, from an FII perspective, not related to India, but the US employment data coming strong. And if inflation doesn't trend down quickly, markets actually post-Fed hike actually are factoring in a higher probability of a rate hike, in which case RBI might be under pressure. So these are all the factors which are preventing that market from really breaking out into a post-war, I would say, boom kind of a rally. After the first day of the ceasefire announcement on Friday, when the markets rallied about 2 to 4% from large cap to micro caps, after that, you're seeing every day it's positive, it's in the green, but 0.5%, 0.4%, 0.7%. It's not really a hot rally. I would say, it keeps consolidating and a lot of sector rotation taking place because DIS, if you remember the month of March, when FIS sold 1.22 lakh crore, they bought 1.5 lakh crore. So a lot of the large caps sold by the FIS were lapped up by DIIs. And now they are selectively booking profits to buy other sectors which they see as more promising. So there's a significant degree of rotation around sectors. And in fact, 2 consecutive days, there are very few sectors which go up on 2 consecutive days. One sector goes up one day, the next day it's in the bottom of the performance. So you are in for, I would say, that consolidating phase, but with a upward bias. Definitely a downward bias. I think there's enough liquidity domestically to protect it from a further fall. But I still wouldn't yet bet on markets, especially the Nifty and all, quickly hitting their lifetime highs, which is at least 2,000 points away, right?
Got it, got it. Sunil sir, before we move back to markets, let me ask you about the biggest headline today. That's your Geo IPO finally getting an approval from the board itself. I mean, what
Mm.
valuation do you think the market is going to assign to the IPO? And of course, do you think it's going to command a premium over Bharti Airtel?
Yeah, I think so. It will command a premium. But for valuations, I think you got to look 3,000 miles away to SpaceX, right? So clearly, when a very promising company comes up, there's a lot of money waiting to bet on the future. And I think it's not just about the current business model of the geo business, it's what they're looking at from a future perspective, right? And so there will be a lot of enthusiasm. So definitely, at least for the start, they will definitely try for and better the valuations of competition, but it should settle down over a period of time because I think Bharti and Reliance are both equally strong players. I wouldn't clearly say that one of them is a clear winner, both of them, and that's a dedicated telecom player. Bharti, whereas Reliance, with the spin-off, will probably be dedicated, but I would still argue that in the long run, both should be at similar valuations because Bharti is well entrenched and all of that. But initially, because of the IPO enthusiasm, right, there could be an uptick in terms of relative valuations.
Got it, got it. Sunil, so you mentioned something about, the Reliance push for the AI related productivity going ahead from here on. So, how do you see the step going from here on? Because recently also now they've announced that, from their O2C business, they are, significantly expanding it to materials and chemicals as well. So, this is a new vertical that they are planning. Do you think it's going to offset the kind of drag O2C used to have because of the higher crude prices?
Well, first of all, the drag on OTC should come down, right? Because now with the war
Hmm.
behind us, oil should be stabilizing, right? So the OTC business would actually now start recovering from that short-term impact of the oil. So the Q1 results will probably be the worst because they will carry the full oil impact. But from Q2 onwards, I would say the OTC itself should be on a recovery track. But that apart, all this focus on AI, I think it's clearly because the world, and you see, why has Reliance the stock been underperforming? It's partly because FIs have been selling. And what have been FIs selling? Anything non-AI, they're not interested right now. So the more Reliance blends an AI into their future, markets it well, speaks about it, is likely to get interest from the FII to participate in the IPO. So definitely I see the AI twinge, and that's why I brought in SpaceX because today the AI is the buzzword, right? And it's I mean I would be foolish not to take advantage of that. But really speaking, also, I think Reliance is probably one of those companies which can make a serious bet around the AI ecosystem, right? They have the cash, they have the vision, and they have that long term commitment. So I would definitely put them at the forefront of any AI related. Pick up growth in India, and if they make those plans clear, you will definitely see interest from foreign participation who want to participate in India but have been staying away because of AI not being perceived as being very friendly to AI, India as a country. So this could help change that perception and do that. So I think it's a smart move of them to talk a lot about AI and actually then go and implement it too.
Okay, got it, got it. All right, that's the key takeaway from the AGM. But yes, let's come back to markets, Sunil sir. The major culprit of today's sell-off, that's been the IT stocks. We saw Accenture narrowing its revenue growth guidance, and every day it looks like the sector keeps getting derated. Even today, Nifty IT hit a three-year low. Do you think this kind of correction is already justified?
Look, if you go by historic valuations, it looks like it's overcorrected. But I think that what's happened is that in the market, right, there's a clear digital. When I say digital, it's either a yes or a no. The thing is that when the market is seeking a growth oriented asset, you got to accept that IT is not a growth play. The charm in IT now is for that they have a sustainable business model which is under threat from AI, but it's not going to vanish. Today's valuations are talking as if after 5 years they fall years of, after 5 years they fall off a cliff, which is not going to be true. So from a pure valuation versus their future growth prospects, it is overcorrected. The problem is that unless liquidity comes from a value zone in to support it, it can be due for greater correction also, because markets tend to overreact one way and then the other way. So I would say that there's a high probability that goes even more into the value zone. I know that there are value investors who are looking at the dividend yields and saying it's corrected a lot, it's a stable business, it's not going to fall off. But one thing they are forgetting here is the fact that IT is coming off a high prior to this AI craze, right? Because post COVID, it was like IT is the answer to everything, the panacea for all things. Where you talk, people are working from home, people are Internet of Things, everything. IT got the benefit of that whole spillover. Now AI is come in and taken up that space. So IT's those frothy valuations have gone away. It is definitely reasonably valued. The problem is that it's not the bottom. This could be even more reasonably valued. It could go even more undervalued before it bounces to a stable level. So, as an investor now, right, I would say that IT can be the part of the value part of your portfolio. Now, how far you want a value oriented stock in your portfolio is the key to holding these IT related stocks. So, in India, unfortunately, not many investors look at value itself. It's the pension funds and the insurance funds from abroad which have clearly a value segment in their portfolio. Well, they'll add the dividend yield to it and said, we need this. So I expect some buying support to come from overseas. But India, DIIs, because they are benchmarked to the indices and the indices still carry double digit IT exposure, will keep buying IT. So there will be a floor forming at some time. But thing is, news days like these, when either a competing IT company reports bad results or your AI company throws another googly, it's saying we are going to attack this part of the business. They're already attacking SAP, they're attacking SaaS, they're attacking stability. So these kind of news flows is in nobody's control, and there will be a panic element to that. So I would say that at this point in time, to me, IT definitely looks like a value buy, but the danger is that it could become even more of a value buy. So be clear in what, when you want to buy IT, is today's correction, is it an opportunity to buy? Yes, maybe. But will it correct a little more at the next such news flow or item? Yes. Would you then go buy some more? Yes. So you keep buying it on the down, but you still have to figure out that one day it will stop and then there will be a stability, which is when you have to hold it as a value component of your portfolio. So the investor thought process has to be very clear, but clearly, if you're a growth oriented investor, IT can't today form part of your portfolio. That's very clear because the signs of growth, you see, the companies are talking AI, but it's still not strong enough. I know TCS, Infosys, everybody is talking about partnerships, saying we are going to use, TCS chairman said we're going to have equal number of AI agents as compared to employees. All of those are good, but at the ground level, concrete, I do not think foreign analysts of FIIs are fully convinced that we are ready to board the AI bandwagon in a big way. I have confidence that they will do it. But right now, it's a PR problem. It's about the fact that the perception is overriding the reality. These companies have enough cash, they are smart enough, they've been long enough in the business, they've seen multiple such things like the dot-com boom and the Y2Ks and everything and gone past. I have confidence that the sector as a whole will survive and thrive. But market perception, unfortunately, isn't the case, especially from a foreign investor's perspective. So I would say the ride is still going to be a jerky ride, a volatile ride. You will see whenever rupee looks like weakening, they'll say, oh, IT will benefit from rupee depreciation. There'll be some buying support. There will be some traders who come and say it's overcorrected, it can bounce back. So it's going to be a very interesting sector from that fact. But unfortunately, for a fairly steady state business, right? Even if you'd say that 40% of their business will go away and the core hump of 60 will remain, for a fairly steady income stream there, the stock prices are going to continue to be volatile. So that's a challenge for any investor to tackle, that I have it as a value component, as a safe component, but there's so much volatility in the stock price. So how do I deal with it? So really interesting, very, very challenging times for the IT sector, I would say.
Okay, got it, got it. So, sir, this week we have seen that rupee has appreciated by about 70 paise. It's below that 95 mark. Do you think these levels are sustainable given that we already had a hawkish Fed policy this week?
Yes, I don't think that is a problem for us because I think the rupee strengthening is more of a liquidity supply issue because till September 30th, RBI is going to pick up the swap costs for the FCNAV deposits. Already, the leading banks are offering 6%, and the smaller banks, I believe, are willing to go up even a percent more easily. So, what is happening is that NRIs, if you go back to 2013, Mr. Rajan's period, when we tried this out, there was a huge leveraged buying of these FCNR bonds. So typically what happens is that customers who already hold FCNR deposits go and pledge it with a bank and borrow up to, let's say, 80-90% of their borrowing, and nine times they're able to leverage. So even if you get, let's say they are getting 6%, and if they're borrowing at, let's say, 4.5%, right? But you leverage it nine times, you're going to end up making 14-15% returns on a risk-free asset, which is the Indian government is never going to default, right? So Indian banks are not going to default. The banks, governments are not going to default. So it's a huge for an NRI. It's a dollar protected asset where he's getting a 14% return. Where else in the world will he get it? Back in his home country is giving him that. So I expect a very decent amount of flows to come in before 30th September. So that short-term expectation of the supply is keeping the rupee, and that supply will actually happen. So to that extent, in the near term, I expect the rupee to slightly even strengthen. Maybe it may hit 94 and breach 94 to 93, 80, 90 also in the short run. But later, after that money is come and absorbed, if the oil prices have again stabilized, let's say at a $70 level, right? Today it's about 78, 79. Let's say it comes to $70 level, then again the rupee will not be under that much pressure. Now, the Fed expectation of a rate hike. So right now, I don't think the RBI, we have a still 240 basis points differential between the two. So if the Fed hikes the rate, that differential will come down, and RBI may need to rate hike. But I don't think that for the currency, RBI has now done enough measures. One is, of course, FCNRB. Second is allowing the public sector enterprises to borrow with half the swap cost being picked up. And the third, of course, is the FI money. And I was seeing some data, I think to the Moneycontrol site only, that something like 32,000 crores has already come into GSECs from debt FIs. So if that kind of a flow is also sustaining, it also gives strength to the rupee. So the near term, actually, the rupee looks to be fairly stable, and like I said, might even strengthen down or at least a one rupee. I feel, but medium term again, 1 year forwards are still showing a 97.25 for the rupee. So that's the normal depreciation which the interest rate differential should lead to. So short term strengthening, medium term some amount of weakening is what I would look at the rupee's status.
Got it, got it. So, Lisa, majority of the analysts who I spoke to this week said that OMC stocks are still trading bets right now. We've seen some cool off in the crude oil prices, and the MOU has already been signed between US and Iran. So, at what point do they become attractive once again?
Well, first of all, there is going to be a hit for these 3 months of prices, right? So there's going to be a significant hit to their numbers already happened. So the market is trying to judge how far that's going to go. So we don't have clarity around that. So the Q1 results will throw clarity around that. Number one. Number two is the fact is that we have 2 months stock of oil, which means they have bought oil at high prices, which means even post the quarter, for some time they'll be dealing with stocks of oil bought at high prices during the war. So it's only from maybe September onwards that based on where the oil prices will they get a cheaper oil to buy, because we didn't want to have a shortage, we actually went and ordered oil at a reasonably high prices. So it's going to be a sustained negative impact for them in terms of the fact that the petrol price is not going to be hiked significantly beyond what's already done, because now with the war solved, it's hard to justify another petrol price hike when already whatever little hikes they've done has not been received well by the general public. So from that point of view, the OMCs are still probably going to be under short-term profitability pressure. And for the situation to turn, we need a huge, drop in Brent crude prices to back to $65, which even the International Energy Agency isn't saying is going to happen in a hurry. There's going to take some time to repair the damaged facilities. There are what 8,000 ships or something that are lined up at the Hormuz Strait waiting to clear. So it's going to take a bit of time for it to ease. And oil, you see, it went down to 77, is back again at 79, 80. It's not really collapsing yet. So It is still $5 cheaper than what the energy agency itself predicted at 85 as a stable price. Now it's going to stabilize at 85. Then that's not really great for the OMC. So that's why the analysts and the market is still saying wait and watch. Let's see what happens in terms of the future oil prices. How much have they contracted at high cost, and what is going to be the impact on the ongoing in the current year's EPS for them? So a lot of things yet not clear about the OMCs. That's why I think a wait and watch approach is a better one at this point in time.
Okay, got it, got it. So, you mentioned that IT is a clear avoid in a portfolio at the current juncture.
I didn't say that. No, no, Lavisha, I said it's a part of the value part of your portfolio. I didn't say
Okay,
avoid. I said if
okay.
to the extent investor will decide how much value he'll have in it. So there is definitely a case adding it to the value component of your portfolio. Just as a growth
Okay.
stock, it's say if you want to say avoid, use the word avoid, say avoid it in the growth part of your portfolio.
Okay, got it, got it. So if an investor has to look at growth specifically, then from a 1 to 2 year time horizon, which themes should they look at?
So now that the fiscal deficit pressure is slightly off because it's going to be contained with over 3 4 months, right? And I think overall, maybe instead of the 4.4, we may end up with a 4.56, a marginal slippage in fiscal deficit. With the dollars coming in, though the trade deficit would have widened, the current account deficit should be back in. I expect the BOP situation also to improve because of the dollar. So overall, macro-wise, India is looking in a better space. Number one. Number two is from an earnings growth perspective, right? I think that the monsoon is probably far more important now that the war is behind us. So from a monsoon perspective, that's going to be what RBI will be also watching on the food inflation part and how far the government will have to act in terms of the supply side to ease the situation, not allow food a shortage of food stocks to be then met by the buffer stocks and take care. The MSP will be a key part. So I would say the monsoon is the near-term concern which we need to address it. But if you look beyond that, right, I think the ongoing the festival season coming in a couple of months, discretionary consumption should rise. I expect private sector capex also to rise. So to me, if you ask me the question about a year and a half now, so for me the story is clearly the capital goods cycle, which I believe with some amount of consumption picking up, capacity utilization should again inch up, and I would expect next year, definitely in the calendar next year itself, private capex should start picking up. And so it's a good time to start accumulating the wider capex infra because some of these capex infrastructure companies are also good export. They execute turnkey projects outside India, and the Gulf rebuilding is going to throw up a lot of work, partly as subcontract, partly as main contractors for the capex sector. So I think even the Gulf rebuilding Indian IT company, I don't want to take names, will Indian manufacturing behemoths should participate, should get good order books there, plus the domestic capex. So I would say that that is probably a time now because the market is not yet fully priced that in. Right, is to start buying into that, and on the back of it, I would add my public sector banks because a lot of capital goods ultimately get subcontracted and executed by SMEs and MSMEs, and for them, the financing to execute their orders has to come from the public sector bank. So I see very good times ahead for the public sector banks in terms of the loans to these are at very reasonably, I would say, high cost in terms of for the borrowers. So it will be in clearly in double-digit interest rates. So the net interest margins of public sector banks should also be taken care. So any shortfall in deposit mobilization and the rates going up shouldn't hurt the fact that these companies will borrow at whatever rates the banks are willing to give to them. So public sector banks plus the broader infra pack. So in infra, I would include a lot of things like cement, steel, non-ferrous metals, EPC contractors, the whole gamut who will be supplying project execution. And that's, I believe, the right time to start looking at those sectors now from a perspective. Shorter term, I would say still discretionary consumption should hold good.
Okay, got it, got it. Sunita, what about defense stocks? I mean, they did garner some interest this week. If you look at Nifty Defense, that's up by about 5 to 6% this week itself. What's your take on the sector, and of course, what lies ahead?
Well, that sector enjoyed the benefit of a geopolitical risk premium, right? They they actually said that defense is during geopolitical risk is good to buy defense. So there's a sentimental buy. But if you really look at it, practically, I think the sector's order books will be strong because whether it's the Gulf who will want to replenish, and now it's all about modern day warfare. It's no longer about the old type of battle tanks and those kind of a thing. It's more about drones, and the Operation Sindoor demonstrated Indian capabilities very strongly. So I expect a lot of the new age private sector defense companies to get order books from the Gulf space for rebuilding their arsenal, from the NATO countries for rebuilding their arsenal, and if the Russia-Ukraine war also is thing, there's also rebuilding work, restocking of ammunition there. So I think the defense space to me looks like the growth will be very robust, but a lot of it is in the price. It's not a value buy; it is a growth buy, and the future growth will justify. But because those valuations are now well pricing in the future growth, be prepared for a volatile ride. So I would still say to those who already hold it, you don't need to rush and panic and sell. To those who want to enter it, I would still say keep a staggered approach to it, because of the price to perfection scenario, there will be volatility every time. Especially, like I said, DIS will need to book profits to buy something else, and defense is the ripe for plucking. So expect some degree of near-term volatility in the prices, but the outlook for the sector is good because worldwide, the whole realization of the new age warfare, and India is in a pole position to be a big defense supplier to the world. And of course, even the Indian government has released what $30 billion worth of orders to the defense sector. So overall, top line growth for these is sustainable and good. I would expect a lot more IPOs also to come into the defense space from the new age private sector companies to hit the markets in the next 2 years. So it'll give you a good opportunity to participate in a lot. So I would say stay invested in the sector. Add on corrections if you want to say. Add on tips.
Okay, got it, got it. All right, Sunil sir, on that note, we have to let you go, but thank you so much for your time and, of course, joining us. All right, that was Sunil for us, taking us through, of course, what lies ahead for the markets when it comes to on an index level, and even from the defense point of view, and of course, what themes look attractive from a 1 to 2 year time horizon. But yes, today the markets have been quite choppy despite the kind of run up that we saw in the past 5 consecutive sessions. We'll watch out how the next week behaves, given that Iran and US have already signed the MOU to end the war. But yes, the contours of the agreement, and of course how the 60-day negotiations takes place, and whether or not crude oil prices continue to behave in the stabilized manner like it is at the current juncture, is something that we'll be watching out for as well. But for that, we'll be coming with our markets next week. For now, it's a wrap from me. Do have a very happy weekend, and for more news updates, do stay tuned to Money Control.